Let's now look at illustration number 3. P Company Limited issuer takes a loan from Q Company Limited, which is the holder. The loan is perpetual and it entitles the holder to a fixed interest rate of 8% per annum. All right, so the loan that P company has taken is perpetual in nature. What does the meaning of perpetual mean? It's the same as irredeemable. It means that the principal does not have a specified stipulated repayment date. All right, the principal does not have a specific maturity date. The repayment of principal does not have a specific maturity date. Further, the information given is that it entitles the holder. P Limited is required to make a payment of 8% per annum to Q Limited. Examine the nature of financial instrument. Again, we are going to examine it from P Company's point of view. All right. So now over here, if we actually examine with regards to the principal, P Limited does not have an obligation to pay cash with respect to principal. All right. Because it does not have any specific stated maturity date, P Company Limited does not have an obligation to pay cash to Q Company Limited with respect to principal. If you look at interest element, if you think of interest element, P Limited has an obligation. It has an obligation to pay 8% per annum to Q Limited every year. All right. It has a contractual obligation to pay cash with respect to interest. All right. So this instrument as well has features of both liability and that of equity. All right. Over here, the equity element was stemming from the principal. All right, the principal does not have a specific maturity date. It is the P Limited does not have an obligation to pay cash to Q Limited. Therefore, the principal has the element of equity. All right, whereas the interest, P Company Limited is required to actually pay interest every year at the rate of 8%. Therefore, the interest has an element of financial liability. All right, the interest is in the nature of liability, whereas the principal, which is not required to be paid, is actually has the characteristic of equity. All right, so this is also a compound financial instrument. All right, this is also a compound financial instrument. All right, it has the characteristics of both equity and that of liability. So how are we actually going to account for it? Let us assume that we are actually taking a loan of 1 lakh rupees. All right, let us assume that the proceeds that we have received today is 1 lakh rupees. We will be debiting bank by 1 lakh and we will be crediting financial liability. We will have financial liability and we will also have equity. All right. So this 1 lakh will actually be split into financial liability and equity on day one. All right. A portion of it will be regarded as a financial liability and a portion will be regarded as equity on day one itself. Now the question is again, how do we calculate the portion of financial liability and equity? How do we actually calculate the amount of financial liability and equity? This is there as part of the same chapter in the advanced illustrations, but we are actually going to do it now itself. All right. Let us actually try finding out the amount of financial liability and equity now itself. The continuation of illustration 3 is basically illustration number 28. All right. It's going to be illustration number 28. That is the continuation of illustration number 3. All right, now let's actually read illustration 28. You'll realize that it's actually nothing but replica of illustration number 3, just with advanced level information to calculate the amount of financial liability and equity. P Company Limited takes a loan from Q Company for 12 lakhs. All right. So the amount of loan that we are taking is rupees 12 lakhs. The loan is perpetual and it entitles the holder to a fixed interest rate of 8%. All right. So because it is perpetual, it basically means that P Limited does not have an obligation to pay this 12 lakhs back. All right. P Limited does not have an obligation to pay this rupees 12 lakhs back. It will pay it at the time of liquidation or at its own discretion. Whenever it wants to, it can repay this 12 lakhs. If it does not repay, as long as the company is active, it will be repaid at the time of liquidation. All right. However, every year P Company Limited has an obligation to pay cash of interest of 8% to Q Company Limited. The rate of interest commensurate with the credit risk profile is 12% per annum. What they are basically saying is the coupon rate that P company is paying to Q company is 8%, but for a similar instrument, P company would have actually issued in the market at a rate of 12%. All right, so the market rate is actually equal to 12 percentage per annum. All right, the market rate is actually equal to 12 percentage per annum. The question is calculate the value of liability and equity components. All right, the question requires us to calculate the value of the liability and equity components. All right, now let us actually start plotting the cash flows. If you think of it, we have got years, we have got cash flow. All right, the cash flow is 8 percentage per annum. All right, the cash flow is 8 percentage per annum on a principal of 12 lakhs. All right, so the cash flow would be 12 lakhs multiplied by 8 percentage, which is going to be equal to 96,000. Now we will be A company limited, or sorry, what was the company? It is P company limited will be required to pay 96,000 in year one. It will be required to pay 96,000 in year two. It is going to be required to pay 96,000 in year three. Give because there is no specific maturity date, it will be required to pay 96,000 every year until the date of liquidation. P company limited has an obligation to pay 96,000 every year until the date of liquidation or until whenever P company chooses to redeem this instrument. All right. Whenever P company chooses to redeem this instrument, it will repay 12 lakhs. And after that, 96,000 is no longer required to be paid. But until then, it has an obligation to pay 96,000 until the liquidation or until the instrument is redeemed. If you think of it, this is basically like an infinite stream of cash flows. All right, this is basically a stream of cash flows which is continuing until infinity or until perpetuity. All right, these cash flows is nothing but it is a stream of cash flows in perpetuity. I have an obligation. P Company Limited has an obligation to pay 96,000 every year until the date of liquidation. So this 96,000 is a perpetuity cash flow. All right. What is recorded as a liability? Remember, this 96,000 payment each year is a contractual obligation. It is necessary for P Company Limited to make this payment, and therefore the liability is supposed to be equal to the present value of this 96,000. The liability is supposed to be equal to present value of 96,000 from year 1 till perpetuity. From year 1 to perpetuity, it has the obligation to pay 96,000 from year 1 to perpetuity, discounted at the market rate of interest of 15 percentage. All right, we are not going to discount it at 8 percentage. Sorry, the market rate is 12 percentage. I'm sorry, the discount rate is going to be 12 percentage, which is the market rate of interest. Now the question is, how do we actually calculate the present value of perpetual cash flows? If you remember, the present value of perpetual cash flows is calculated by the formula cash flow divided by interest rate. All right, it's cash flow divided by interest rate. You might have learned it in your basics of FM. It's perpetual cash flows. The present value is calculated as cash flow per annum divided by interest rate, which in this case is 96,000 divided by 12 percentage, which is going to be equal to 8 lakh rupees. All right. So the present value of 96,000 from year one till perpetuity discounted at 12 percentage per annum is 8 lakhs. All right. This 8 lakhs represents the present value of the obligation that P Limited has to pay 96,000 every year until the date of liquidation. This 8 lakhs represents the present value of 96,000 payable by P to Q company from year one till perpetuity. All right, remember the total proceeds that we received. The total proceeds that we received is actually equal to 12 lakhs. The total proceeds that we received is equal to 12 lakh rupees. Of this 12 lakh rupees, what we are doing is we are classifying 8 lakhs as liability. We are classifying 8 lakhs as liability. This basically represents the obligation to pay 96,000 each year, and the remaining 4 lakhs, the balancing figure, is going to be classified as equity. The balancing figure is going to be classified as equity. So we have split 12 lakhs into 8 lakhs as liability and 4 lakhs as equity, and this is therefore called as split accounting. All right, this is therefore called as split accounting because we are splitting the proceeds that we received into liability component and equity component. So the journal entry was going to be bank account debit of 12 lakh rupees to financial liability of 8 lakh rupees, and then we are going to have to equity of 4 lakh rupees. All right, so we are going to have bank account debit 12 lakhs, to financial liability 8 lakhs, and then we are going to have equity of 4 lakh rupees. Now, on this financial liability of 8 lakhs, what we are actually going to do is every year we will be recognizing interest at the discount rate. We are going to recognize interest at the discount rate of 12 percentage. We will be recognizing interest not at the coupon rate, but we will be calculating interest using the market rate or the discount rate. All right, so interest for year one is going to be equal to 8 lakhs multiplied by 12 percentage, which is equal to 96,000. If you notice, this 96,000 is nothing but the amount of interest that you're going to pay every year. This 96,000 is basically nothing but the interest that you're going to pay every year. That interest is going to be recognized as an interest expense. That interest will be recognized as an expense in the P&L account. All right, so whatever 96,000 you're going to pay each year, that will be regarded as an expense in the P&L account. All right, so every year we are going to show a financial liability of 8 lakhs on the balance sheet, and the 96,000 interest that we're paying will be recognized as an expense in the P&L account. It will be recorded as an expense in the P&L account. Now, whenever, let's say 10 years later, I am redeeming this instrument. All right, 10 years later, I decide to repay the 12 lakhs. All right, I have made sufficient profits over a period of time. I now decide that it's no longer viable for me to keep paying interest at the rate of 96,000 each year. So therefore, I decide to actually repay the principal amount. All right, at that point in time, the financial liability will still have 8 lakhs as its balance. The financial liability will have 8 lakhs as its balance. So when I actually repay 12 lakhs, the journal entry for that will be financial liability debit 8 lakhs. I will then debit equity. All right, I am going to debit equity. Whatever equity got credited over here, that equity will get debited by 4 lakhs, and then I am going to repay the cash of 12 lakhs. All right, but this will happen whenever the entity decides to actually repay the principal amount. All right, there is no obligation for the entity to pay this principal. Whenever the entity decides to pay cash, this is the journal entry that we will be recording. All right, the financial liability subsequent measurement is basically at amortized cost. All right, we're measuring the financial liability at amortized cost. If you do not know what amortized cost is, that's fine, but what we are essentially doing is recognizing this financial liability in our books, and we are going to recognize interest at the market rate. All right, we're going to recognize interest at the market rate. All right, this continues to be 96,000, which is equal to the cash that we're recording. All right, in the previous illustration, in one of the previous illustrations, I said that the journal entry for this interest is going to be interest debit to financial liability. I said it's going to be interest debit to financial liability of 96,000. All right, now the journal entry is the same. The only difference from the other illustration is over here in this, whenever we are recording interest, we are also going to actually pay that interest immediately. All right, we're going to pay that interest, and therefore journal entry for that will be financial liability debit to cash. All right, so recording of interest, the journal is interest debit to financial liability. When I pay the interest, it will be financial liability debit to cash account, and therefore the amount of liability stays constant. I credit financial liability by 96,000, and I also debit financial liability by 96,000 because I'm making that payment, and therefore the amount of financial liability remains constant at 8 lakhs throughout the period. All right, so with that, we're done with both illustration number 3 and also illustration number 28.